Hello, everyone. Welcome to another episode of ET Market Smart Talk. Well, I'm your host, Shataj Anand, and today we'll be decoding the Reserve Bank of India's latest monetary policy decision and what it means for growth, inflation, and market dynamics going into FY26. Well, joining us is Garima Kapoor, is economist and executive vice president at Elara Capital. Garima, thank you so much for taking the time out and join us today.
Thank you, Shitish. Thank you for having me.
Thank you so much for taking the time out, Garima. And well, to start with, what is your take on the recent RBI monetary policy outcome?
I think with respect to decision, purely it was mainly on the expected lines that they decided to not change the rate as well as maintain the stance. But the
Sure.
policy was fairly dovish. I think the policy, more than the rate decision and the stance, it
Mhm.
stood out me from the point of view of the deregulation initiative that RBI has taken,
Mhm.
especially in trying to expand the ambit of business for India's commercial banks. And by that definition, I think the policy was unique. It was more forward looking. And I think more than that, it has opened up an avenue for the banking sector, which was until very
Mhm.
long time reserved for, let's say, for foreign banks or PE or VC funding.
Absolutely. The 22 measures, very calibrated when it comes to numerology as well. So, yes, we'll not go deeper into that part of it. But yes, so I'm sure it'll open more, avenues for the banking sector, as you rightly pointed out. But yes, whenever there's a policy, then there are expectations of a rate cut. Well, it did not come through this time around. But do you see, let's say, another 50 bips kind of a rate cut in FY26? And, what are the key factors driving that expectations? And how likely is a December 25 rate cut on the cards?
I think the policy gave significant hints this time in the post-policy conference, as well as some of the statements that were in the policy that the sobering of inflation has given greater leeway for monetary policy to support growth. I
Hmm.
think we have to look at broadly in terms of what does the outlook for inflation look from here on, while it has been persistently undershooting. The 2.6% CPI mandate that RBI has set, or rather the forecast that RBI has put out, is
Right.
likely to also get undershot by 10 to 15 basis point. For the month
Okay.
of September, we're looking at a headline CPI of below 1.5%. I do not know when was the last time in India's history you
Yeah.
probably saw that print. Um,
Right.
the outlook also looks pretty benign, while there are idiosyncratic behavior in food prices. Taking
Hmm.
into account energy and global commodity prices in general, it does look like you will continue to remain fairly muted in terms of inflation outlook. And that, in my view, opens up space for policy to act, especially
Hmm.
when Fed has started to re-embark on its rate cut trajectory. And that's why we probably expect another 50 basis point rate cut with a
Hmm.
25 basis point going through in December policy itself.
All right. Well, 25 basis point is something which Garima is looking at in the upcoming December policy. Well, you did talk about the GDP growth print, and despite the upward revision in GDP growth to 6.8%, in fact, the report that you've written mentions downside risk in H2 FY26. What factors could sort of derail growth in the second half?
I think the upgrades to GDP estimate that have happened by RBI should be
Hmm.
looked at in the backdrop of what print came in quarter one. The quarter one 7.8% print was at least 50 to 70 basis point above RBI's and consensus estimates. So that really drove the upgrades because everything else being equal, even if you don't do well in subsequent quarters, you'll end up at a growth which is close to say 7%. But the second half of the print, the GDP print, expectations were actually revised down by RBI by 20 basis point. Now,
Right.
if you look very fine print of RBI policy, they do talk about risk to growth. In my
Hmm.
view, the most obvious risk to growth emanates from external sector, while the expectations around likelihood of a conclusion of India-US deal has
Hmm.
actually increased now versus, let's say, a month ago or a couple of months ago. The actual timing of when it will actually conclude And more so, what happens to the 25% penal rate that has been there for purchase of Russian oil is something that one needs to factor in. Also, while monsoon has been good overall on a headline basis, there have been very episodes of concentrated rains in parts and flooding in parts of India, which is likely to be negative in terms
Mm,
of your agriculture output and hence to some extent the
mm,
cultivation and agri income. So these two risks I do see as the biggest risks in the horizon. But because quarter one was so robust and quarter two probably will also be around the handle of 7%, for the full year basis, we are looking at a 7% growth, notwithstanding these risks. But if an RBI is an RBI which the same governor until few policies ago mentioned that India should strive for much stronger growth rate,
right.
and we need to not be satisfied with the current 7% handle. And
Mm.
given the backdrop of inflation, it does create room for rate cuts despite upgrades and upside revisions to the GDP rate.
Absolutely. And how significant is the role of public capex and rural demand in sustaining domestic activity amid global uncertainties that we're seeing at this point in time?
I would say, Shatish, public capex is far, far important, particularly in the absence of a broad-based uptick in private capex, which the broad-based uptick in private capex has probably been eluding India for nearly 2 years and 3 years, ever since the public capex has taken the role of driving the capex demand. Just to put
Mm,
in context, in the first 5 months of the current financial year, the center plus state put together, capex spending has grown more than 40% year on year. Same
okay.
time last year, it degrew by 11%. And we know what happened in the quarter two GDP print last year, where we saw
Mm,
a print of sub 6%. So I would
mm,
say, in the presence of external headwinds and in the presence that domestic private capex uptick is
mm,
not yet broad based, public capex is going to play a very formidable role. Now, coming to rural demand for last few quarters, particularly I should say 6 to 8 quarters, has been the driving force of India consumption,
sure.
even when the domestic demand remains soft. Now, our channel checks and our assessment tells us that the crop has not yet got harvested. So, a significant part of rural demand will start to play out in the Diwali festive season, in
Okay.
absence of which the festive as a whole is unlikely to be very robust. So we will need that rural demand to complement the return of urban consumer. So I would say both rural demand as well as the public capex are going
Mm,
to play a very critical role during a time when private capex and external headwinds are the two risks to growth going forward.
absolutely. And how might the expectations of another 50 basis point rate cut impact bond yields, particularly at the longer end of the, let's say, 10-year G-Sec?
So the 10-year GSEC, actually, when we talk the longer end of the curve, something very peculiar happened for last few years, particularly a couple of years. Uh, this year, the first half of current financial year, saw
Hmm.
supply in 30 and 50-year tenor, at as high as 34%. That led to significant spiking up of long-term yields in India,
Hmm.
and in response to which the government's borrowing calendar for the second half trimmed down the supply in the longer end of the curve, that is 30 to 50-year category, by from 34% to 29%. So you are beginning to see some respite in an extreme long end of the yield curve. Now, coming to the 10-year category, which is the belly of the curve, you have seen an increase in supply by nearly 2%. Given that the global outlook for the rate cuts, particularly by Fed, is not that buoyant, and there are so many headwinds globally, I do see that Indian 10-year yield will broadly, oscillate in the range of 6.4 to 6.6, despite expectation of an RBI rate cut going forward.
Absolutely. And finally, let me also get your perspective on the central bankers across the globe. So, what are the potential implication of, let's say, Fed-driven global financial conditions on RBI domestic policy stance?
I think one of the reasons why RBI has stayed pat, particularly for the previous two policies, that is one before the October policy, was
Mm,
that Fed paused its rate cut trajectory.
mm,
Now, critically, Fed's policy determines to a large extent the transmission by emerging market central
Mm.
banks and does create volatility and vulnerability from flows to currencies. We've seen that. But an
Correct.
added perspective to all of this has been really what's happening in Japan.
Mm.
The yields in Japan have been spiking at an all-time high
Right.
because of a variety of reasons, including political uncertainty. And you've
Mm.
seen very sharp depreciation of JPY against the USD, which has already seen a meltdown of about 4% month till date. So these factors are also creating an added vulnerability to emerging market central banks because there
Mm.
are concerns of unwinding of carry trade and otherwise. So I do think in the current juncture, when there are so many moving parts, right from high fiscal deficit of US to the US government shutdown to what's happening in Japan,
Yes.
continued wars and geopolitical uncertainty, the degrees of freedom for an emerging market central bank do get curtailed. And that partly explains why RBI may not have cut in the recent 2, 3 policies and would have liked to keep, its firepower the ready should any of these vulnerabilities manifest themselves more prominently going forward.
Absolutely. Well, on that note, thank you so much for your valuable insights, Karma. It's clear that while India's growth story remains strong, both domestic policy and global cues will sort of shape how the next leg of economic cycle unfolds. And on that note, thank you so much for your time. Thanks for being part of ET Market Smart Talk. Thank you so much.
Thank you, Jitish. Thank you.